What's going on, guys? Welcome back for another episode here on Let It Grow Investing. I'm Jeff. We're going to be going a little bit off the cuff today. We're going to be covering a lot of different things. We got the upcoming Fed report. We've got some moves that I made in my portfolio. We were talking about what was that covered call that I had that expired? Was it? I'm trying to forget. Trying to think. And I actually sold some AMD as well. I got to get back to that covered call. Google. Yes, Google. That was the one that sold. 305. This was last week. So I told you guys I had essentially $30,000 of Google money that I sold out of because of the rapid rise in Google from the standpoint of I didn't think they had so much more room to run. I wrote that covered call. It triggered. And now I'm, was stuck with the idea of what do you do with this money after you sell all these shares. And then I made another crazy play. I decided I am done with United Health, UNH. So I sold out of that as well. So that was another $30,000 of United Health that I sold just this week. And yeah, I mean, I've been waiting for United Health to make a comeback. I know it's a dog of the Dow. It is the worst performing stock in the Dow this year. And yeah, there was still the trial with the CEO, everything that was going on there. I don't even know if I can say the words or if I'm going to get banned from saying the M word as to what happened there. So I'm going through that whole trial. I'm just watching everything that's kind of unfolding. I'm looking at their numbers, and that was really what got me, right? I will pull up Refinitiv on United Health. I will share this tab with you guys. I want to do a quick recap as to why I sold United Health, right? When we're looking at this thing, we're at a 17 on the PE. That's trailing 12 months. The quarterly dividend 2.5%. I don't really see so much in the way of upside. I pulled up the wrong tab by accident, but I will take a look at what the analysts are saying. They're saying about 19% of upside, right? So that looks okay. But when I'm actually getting into the actual numbers here, that is where I got concerned. And it was a lot of a decision as to where do I really want to focus my money? Where do I want to put things into play, right? The 1 year return being down 45%, that definitely does weigh on you after some time. Could it be a time that you should be buying? Maybe, right? I mean, I definitely think there is potentially some upside, but I thought there was upside in other positions without a lot of the headwinds that United Health has had. I'll let, AbbVie and Eli Lilly do a lot of the heavy lifting in the medical portion of my portfolio. Those are probably my two big players at this point. So yeah, there is 17% of upside here. I'm looking at some of the numbers here, though, right? This was the earnings from 2024 at $27.66. For 2025, we dropped down to $16.31. And then for 2026, we might be going up $1.40, but we are still around $10 under the 2024 numbers on earnings per share. We're also looking at, what Trump is doing, what Kennedy's doing, the amount of coverage that they're going to be willing to pay out for different services. They're trying to crack down on things that maybe insurance companies were charging for, different medication prices that insurance companies are charging or not covering on a lot of those different things. So there was a lot of different reasons as to why I thought this one was kind of in the crosshairs right now. We are getting revenues growing for the next 2 years, but when it comes to that bottom line number, we are seeing the actual earnings dropping and then kind of recovering slightly for 2026. So not necessarily where you want to be when you're looking for a quick turnaround play. I never really thought it was going to be such a quick turnaround. I did think maybe when it dropped after the CEO, problems that we could potentially buy that and wait for the recovery. But I've just kind of decided to take my portfolio in some different directions on some fronts, right? So dividend growth, 8.3%, decent. Dividend payout ratio, not scary, 45.5%. So I'm not saying that this is a terrible stock. I still like the company. I do believe it's one of the better run insurance companies. But yeah, I'm not seeing such of the writing on the wall that this thing is just going to go to the moon. So even with this lowered numbers, right, we're still looking at being at a 0.3% premium. I know it's only 0.3%, but it's not really a screaming number when you're going forward that this is at such a discount to where we normally trade. I'm not really seeing any sign there that was like, man, I've got to buy this. Similar on, trailing's a little bit low, but on the forward peg ratio, this is certainly high, right? And granted, we know that they don't have the growth right now. So that is also skewing this fairly greatly. They don't have the growth, but generally speaking, the S&P 500 is a 1.8 right now. The 5-year average of United Health is a 1.7, and currently we are trading at a 7.7. That makes it really hard to justify where they are at as far as a peg ratio to growth. That makes me want to buy more of this stock. So with those things in mind, knowing that I wanted to take my portfolio a couple different places, I'm probably extra heavy in tech right now. I will show you what I bought this week. I'm probably going to have to navigate away from some of these positions and try to rebalance as things grow. But I do believe in the next 18 to 24 months that we're going to have a lot of growth in a lot of these AI names, even some of the ones that have traded down recently. I'm looking at NVDA, I'm looking at AMD, and I'm trying to make a heads or tails decision as to where these things go going forward. And right now, I think that they're both good value for what you're getting, right? You're not paying this 7.7 peg ratio when it comes to something like NVIDIA. You're just not. So from that standpoint, yes, there is some risk associated with both names, but I think that the valuation on NVIDIA makes a lot more sense for me right now. But that's just what I'm looking at. So when I go back over to what I did buy this week, let's get this pulled up. I'll try to get this pulled up in the background so you guys can take a look without maybe all of my information. We will go ahead and share this one now, and we will see just what we are buying. So here we go. We've got, this is my E-Trade. This is what I have bought this week. It's a fairly long list, guys. I mean, it's very tech heavy. I already said that. I did buy some more Adobe, the MicroStrategy ETF, I'll call it, which is heavy on dividends. I don't know that it's for everyone. It has been going down in principal amount. The share price has been going down, but the dividend is insane, that the amount that they pay out weekly. Or that one might be monthly. It might be ULTY that's weekly. I might have that flipped. AMD, Broadcom, Salesforce. Salesforce and Broadcom had spectacular Fridays. I think they were both up 5 or 6%, which I've been waiting for that. I told you guys I wanted to build a position in both of those. Salesforce, Amazon, ULTY, the ultra high dividend yield. Purchase this. I did say it wrong last week. Their earnings are actually on the 11th, not the 1st. So I did get that wrong, but I did say if it was going under 400, I was going to be buying it. I bought here at 383, and I lowered and bought back some more shares at 375, 374.75. Google, UPS, bought some more UPS. I know some of those numbers were actually looking pretty good. It looked like the turnaround was actually starting to happen. So I've been building a position on UPS, and that 7% dividend yield is fairly safe. According to the CEO, looking at some of the numbers, those dividends look fairly safe right now. More Realty. I wanted to get some dividends thrown in there. Again, more Adobe. Bought at 323 here, and then I wanted to buy some more, so I added on the 4th. We've got this sell on United Health. Sold there. Bought some BITX, which is also a leveraged Bitcoin play. I told you guys if it got down into the 80s, 80,000 range, I was going to be buying Bitcoin. What I did was this 2x leverage Bitcoin play, and my hope here is to see this thing kind of run up pretty rapidly, maybe by January, February, and then I will likely trade out of this. I don't tend to really be a trader, more of a long-term buy and hold. I mean, yes, I've sold some things. Yes, the covered calls have triggered. But overall, I try to keep my shares where they are. So yeah, that was all this week. I think there's still more from this week. Yep, we've got a little bit more of the same. Adobe CRM. We bought some SMR, some New Scale, which is that why can't I think of the name? Nuclear power. That is what I was trying to come up with. Nuclear power. The modular systems that they're building for grid power. AMD, bought some more there. Bought some NVIDIA. Bought some more UPS. Bought some more Tesla. bought some Meta. It was a busy week for me, guys. I did a lot of buying. There's still some money left on the sidelines, and I will see what kind of values we find this week. That is what I've got. So yeah, I've got a lot of things going on there. We are watching the Fed. We're watching to see what they come out with on Wednesday. And we're going to see if they do go ahead and cut rates. We're looking at some different things kind of playing out. We'll see ultimately what happens with them. And I do think a lot of the different growth stocks or things that do better when we have lower rates are doing well, right? We're looking at Ulta. Ulta had a great Friday as well. We are looking at them being up. It was around 13% on Friday. Yeah, I mean, we got more money. We're going to buy more cosmetics. We're going to go out. We're going to spend more. We're going to go, maybe hit the town a little bit. I don't know. That's what people are looking at, being up 12%, 13% in a single trading day. So yeah, there is more of that spend going on. If rates come down, that's generally better for a lot of these retail stocks, a lot of the small growth stocks that need to borrow at cheaper rates. That helps them significantly. Do we necessarily want to load the boat on them? That's up to you, right? I don't necessarily want to load the boat. I like some of these larger tried and true plays with a little bit of growth and risk mixed in there. That's kind of my balance. A little bit of value, a little bit of growth. And, we've got some small growth stocks thrown in there as well. So that is what I've got there. I did want to take a quick look at this one. And this is from Instagram. I have not shared this one before, but this is a page that I follow, Stock Market News. This is definitely the 10 stocks in the S&P 500 that have more than doubled in 2025. And I don't have but I have two of these. I have Micron and I have Palantir in my portfolio. I had Lam Research for a long time. I did have a covered call on that one that wiped those out. And I put that money, probably into some more tech names. Western Digital Storage, digital storage. We've got them up 262%. Robinhood, man, this thing has been all over the market, up, down, sideways, and somehow it's up 244% this year. Seagate, similar to Western Digital. So a lot of chip names here. Yes, a lot of chip names. I'm not sure what Amphenol is. APH up 102%. I should probably know that one. But yeah, definitely some big gains out there for them. I did know that there was another one. Let's go through this real quick. Warren Buffett bought 17.8 million shares of Google during Q3. We looked at that before. 50 largest stocks in the U.S. have performed over the last decade. The 10-year average annual return. I was going to say NVIDIA is way more than 72%, but 72% per year over the last 10 years. That is phenomenal. Should have bought every last share of NVIDIA from the time they went public, and you'd be super wealthy. But yeah, NVIDIA, Apple, Google, Microsoft, Amazon, Broadcom, Meta or Facebook, Tesla, Berkshire, Berkby, Eli Lilly, Walmart, and JP Morgan. I think the only thing I don't own on this list is Berkshire, Walmart. Yeah, just Berkshire and Walmart. That's the only things I do not own from this list. So that's kind of cool to see. But yeah, we've got this here. If you would invest in $10,000 into NVIDIA when it went public in 99, yeah, you'd have $70 million. So that hurts. I was not buying stocks in 99, but definitely something, hindsight being 2020. We wish we all were there and we were buying it. So that's what I got there. Bitcoin has had a bit of a run and then kind of pulled back. So we're watching that. We're watching the Fed. We're trying to figure out where do we want to invest going forward. That is generally the answer, or generally the question that we're all trying to find that answer to, right? And I told you guys this past week I was buying NVIDIA for the Investing Challenge portfolio. We've been buying Meta. We've got NVIDIA looking like it's a buy. That's the 1,253% over 5 years. That is fantastic. We've got 37% upside here versus 19 on the one that I sold United Health. That's the name I was trying to come up with. Man, that was painful. 37% of upside here, 19 or 17% on United Health. So about double when you're looking at NVIDIA on that upside. We've got annual revenue going through the roof, 63% for 26. Another call it 150% by the end of 27 from today. That is all that's added on top of 2026's numbers. So 148 over that 2-year period of annual revenue growth. We've got earnings per share growth as well, right? This is a lot smoother of a chart up and to the right. We love to see that. United Health is in that rocky period, and we really don't know what's going to happen there. So we're looking at dividend growth of 42.9%. Yes, the dividend is nothing to speak of, but they are, looking to increase it. So I guess I'll take any kind of dividend they want to throw our way. Forward PE, it is at a discount. We were looking at United Health being at a slight premium. So we're buying NVDA at a discount compared to where we normally find this stock, right? Where we normally find it trading on that price to earnings metric. We're looking at, yes, it's high, but it is lower than their 5-year average on trailing. It's lower on their forward PE, and it is lower than the S&P 500 average of a 1.8. They normally trade at a 1.3, but currently they are trading at a 0.7. So that means you are buying this at a better starting point than, maybe, maybe back in 2023, we had a little bit better when it got down to like a 0.3, but it is at a point where I feel comfortable buying this thing. So that is one of the reasons that I was looking to get out of, looking to take some of that money from United Health and invest it into some other areas that made more sense to me. And it wasn't just NVIDIA, right? It was not just NVIDIA. If I went and looked at AMD, if I went and looked at Salesforce or Adobe, let's take a look at Salesforce, because that is definitely one that has been making, it was also number 2 worst stock in the Dow, right? It's not been doing well. But I do think with Agentforce, I think with some of this different stuff that we've had going on, I'll show this on Yahoo Finance. We've had some good news coming out of Salesforce for ticker CRM, right? Annual recurring revenue, ARR, from Agentforce and Data 360 soared a stunning 114% year over year to $1.4 billion. We had Agentforce alone crossed $500 million in ARR in Q3, rising 330%. And the stock traded down. This was after earnings. The stock traded down, right? So we've got more deals with Agentforce. We got 9,500 paid deals, a 50% quarter over quarter increase. Had, saying that the software giant has been rewarding shareholders. Company returned $4.2 billion through $3.8 billion in share buybacks and $395 million in dividends. So they are focused on the shareholder. We are seeing some of these numbers go up. They had some trickiness in there. They probably they did underpromise, and they had said that their numbers were going to be light. They did beat them, but I think people still wanted to see more. So we are definitely watching to see what this next earnings report says. But I do believe that we are in an optimistic time. I do think that is true, right? We expect the EPS, they did guide higher at the last earnings, right? So 1175 to 1177, revenue between 41.45 billion and 41.55 billion. And they, both ranges come in above its prior forecast of 1133 and 1137. And 41.1 to $41.3 billion. So they did raise those numbers. So we've got some upside there. So that definitely makes me think that this one can turn around quicker than what United Health is. So I don't mind buying a stock when it's down, but I like to know that we have a clear vision going forward that shows that this thing has a path to start going up again. I think that United Health can do it. I just don't know, with all the headwinds of politics being in the way, with the trial and the CEO and everything else in medicine right now, if it is where I want to have that money kind of parked. So if we look at Salesforce and we share this one instead, we are looking at a stock that is not a big dividend payer, right? Is a 0.7% dividend yielder. Yes, they returned $400 million to shareholders, but it doesn't really seem like that much when you're, only holding a couple shares here. But it is a buy rating. 5-year return, 9.6, but we've lost 32% in the past 1 year. And that is one of the reasons I've been looking to build a position in this thing. It's trading down, but the future looks brighter. So when we're looking at this thing, we have 31% of upside compared to 17% on United Health. We've got earnings per share going up and to the right. Is it monumental like what NVIDIA's might be? No, but we're going from 1020 up to 1162, so we're up what 15%. I will take that, and then we're going up to 1297, right? So we have this path going forward that we look like we can actually be making some more money. Revenue, high single digits to low double digits on annual revenue for 26 and 27. But that is also coming off of a downward, last year, right? We're down 30 some percent over the last year. So I do think we can fill in some of that gap as well. They are raising this dividend 33 or 37%. Current dividend yield is only 0.7, but they are raising it. They are trying to give money back to the investors. I like that. We are also at a 45% discount on forward PE compared to the 5-year average. So again, it's cheaper. The forward peg is cheaper. It's at a 1.5. The 5-year average is a 2.5. So it is at a discount. The growth is modest, right? High single digits, low double digits, but it's there compared to having my money parked in United Health, where I don't necessarily think that it's going to get out of its own way. And we still have all the political headwinds to focus on there as well. So for me, stocks like CRM, stocks like NVIDIA, Adobe, I think they make a little bit more sense right now than trying to wait it out for United Health. Do I think they can do it? Yes, but I don't know when. And that is what hurts for, trying to be a long-term investor. If I can have that $10, $20, $30,000 making money, I would much rather do that than just have it parked and doing nothing. So I made the decision, and it is a stock that I've held for quite a long time, to sell out of it and to reinvest that money where I thought it was better suited for my portfolio at this time. Am I a little bit tech heavy right now? Yes, I am. I know I am, and I need to address that as well. But that's what I've got. And now I'm probably going to go a little bit off script. It is in the money aspect, and I'll probably sit back for this one. I probably have a rant coming in. I feel it, but we'll take a quick drink. I've heard a lot of people complaining lately that it is too expensive to live anymore, and they've compared it often to our grandparents, right? The people that were in the 50s and 60s, and they were making a living and having a family, and they had one income and they were able to do everything. I know it's expensive out there. I see it. I'm buying the same stuff that you guys are buying, but I do feel like we're kind of comparing apples and oranges, right? I think a lot of people look at the 50s and you see, a small house and one income, and they had probably more kids on average, and they were able to do it on one income. But I also look at the things that my grandparents did, or what we purchase as, I'm firmly in the millennial camp. I'm, an 87 baby. So I'm firmly in the millennial area. So I see what we buy. I see what they bought. And I try to think about the things that we do different than what they do, right? And I know a lot of people are going to come out here and say, oh, yeah, don't buy Starbucks every day. That $6 coffee adds up. Yeah, $30 a day is, north of 10 grand a year. And it is, right? It adds up really, really quickly. But I think a lot of people say, well, I don't buy things like that. I don't buy, coffee. I don't buy cigarettes. That's not me. But what do you buy? And I'm looking at everyone. I'm not just looking at, one specific person. I'm saying as a nation, we buy so much more than maybe what we did in the 50s, right? We are even more ingrained in the consumer economy than ever before. I look at the subscriptions that we all have. We all pay for Netflix, for Hulu, for Disney, for YouTube TV, for cable. We all have phone bills for multiple lines and unlimited and this, that, the other. They didn't have that. I'm looking at all the different things that, in your car. You have subscriptions for different things there, for subscriptions for Costco, for Amazon, for pick a thing. You have another subscription. And I just see it all add up, and people trying to compare this era to that era, when I know that my grandparents would would save rubber bands from broccoli or save aluminum foil because there was a shortage when they were kids. And I know that they would fix things rather than just toss them out. We definitely are in a disposable type materialistic economy. And I understand that that is the norm, but that doesn't mean that you have to do that. It is very easy to get caught up in the trap of, well, I have to have this. I've got to buy the new iPhone. I've got to buy the new whatever. I think some people look at it like, oh, that's not me. Yeah, I'm in debt, but I don't go buy coffee. But if you're not saving, or if you're not able to save 20% of every paycheck, that is also something that you need to take a look at and say, where can I cut back and how can I be more frugal to not have 47 different streaming platforms, to not have every different subscription, whether it be for, pick a website, pick a Costco, or whatever it might be. And I don't know what that might be for you, but take a look at your own self. If you can't save 20% per month, and that could be a you problem. It definitely could, right? I'm not trying to be mean. I'm trying to be factual. But if you made $30,000 and you were just getting by, yeah, that's tough to do. But then if you make $60,000 and you're still, living now at $60,000 and you don't have any more money saved, that's probably on you. And especially if you get to 100 or 200 or $250,000 of income and you don't have two nickels to rub together, it's probably on you. You have this budget creep along with the income that comes with it, right? So I see what we make. I know where a lot of people spend it because you see it. People want to be materialistic. You want to have the Jordans. You want to have new shoes, new pants, new car, the newest phone. And then we complain that, oh, it was so much easier back when, right? I don't necessarily know that that's exactly true, but we have budget creep of I need this, that, the other, and then we complain about it, right? I just want to see you guys be able to stack more money into your investments, live comfortably, not be paycheck to paycheck. That is originally why I was here, right? There was far too many people that I could give a paycheck to on Friday, and by Sunday, they would even call me and say, hey, can you give me an advance for next week? I'm like, dude, I just paid you. And yes, it's all gone already. And then they'd come in with some ridiculous thing that, they spent money on that they didn't need to spend money on, in my mind. Granted, you're going to spend your money how you're going to spend it. But you can't complain that you're broke when you go out and spend it all on things that you don't need just to have it, just to have a new thing. So I see it. I know it's tough out there. I know that food is expensive. I know that, gas and everything else and insurance and cars and everything is through the roof expensive. But where can you cut back in order to save 20% per paycheck in order to get yourself in a better position going forward? And ultimately, that's why I'm here. That $200 number, that probably came from what can we save per week out of what we normally spend to put into the investing challenge, right? I know we did the math before to see exactly what $10,000 a year on a daily basis broke down to. And we'll just do it. $10,000 divided by 365 is $27 per day. That if you spend $27 per day on things that you don't need, it adds up to $10,000. And that is about the amount of money that I put in every week into the investing challenge portfolio. And that's done pretty well, right? We're up 30%, 40% at this point. And yes, you could have spent the money on other things, but if you invest it, you would have had that initial principal saved and then the growth on top of it. And that is the difference. The difference is that the money that you spent already no longer can grow for you. The money that you still have and you have it invested, it can grow in perpetuity to make you money going forward. I'm not saying to not go on vacation. I'm not saying to not do anything or never go out to dinner. I'm saying be able to pocket some of that money that you spend on the regular on things that maybe you don't need. I know this isn't going to reach everyone. I know that a lot of people that are listening are thinking, yeah, I've been saying the same thing to my buddy for ages, right? But I do think that there are the people that need to hear it. And I see it frequently. So from that standpoint, it makes it really hard to not address it at some point in time. So yeah, I'll show, I don't know if it'll even pick up. But anyhow, we have started this investing challenge portfolio. We have $52,000 saved in this one account, and we are up $15,000 or 41.2% in this one account by investing $200 per week without fail. I haven't stopped. I've told you guys every week. I've let you guys vote on it. I've tried to give everyone an equal shot to do the same thing and invest the money. Some people say I can't. I don't have the money, and I understand that. But find a way to make it happen for you and for your future, right? That is why I'm here. That's pretty much the one reason that got me started in this, is seeing too many people not know where to begin. That's why I've put in different ways to start. We looked at all the different things that you can start investing in for your first $10,000. There's been episodes on that. We've looked at all the different stocks that can grow a lot for you, or the ones that are going to give you the dividends simply by tucking the money away and letting it grow. That is why I've been here. That's kind of the story I've been preaching. And I've seen it for so long. And it just gets built up to the point where I just have to address it on here once again as to why I'm here, and a lot of the pity party as to why I don't have it, because I can't afford groceries or whatever. But then I see how people live and where they spend all their money. And it gets to you as someone that wants to see everyone succeed. That's really it. I want to see people do better with their money. I know it's not taught in schools. I know even at the college level, I got a little bit of stock exposure, but not a lot. I had some financial classes. I had a little bit of a capstone business management class that exposed you to more of what it meant to be a solid business with good numbers, and through some accounting classes as well. But yeah, that's essentially why I'm here, guys, is to try to get everyone to that path of financial freedom. So if that rings true to you, please feel free to share this with someone that maybe needs to hear it. Maybe you don't want to tell them yourself. I can be the bad guy. It's fine. So thank you guys for stopping by. Please make sure you like, subscribe, and share, and I'll catch you in the next one. Take care.